Let's summarize the flow of the merchandising cost in the accounting cycle. First, we purchase from our supplier the goods that we will be selling. We deduct the purchase discounts, the purchase returns and allowances, and we call that net purchases. We also might have some beginning inventory, goods that we hadn't sold from our prior period. Our beginning inventory plus our net purchases equal merchandise available for sale. That merchandise available for sale is either sold and becomes cost of goods sold and moves on to the income statement, or it becomes ending inventory and winds up on our balance sheet. Ending inventory in accounting period 1 becomes the beginning inventory for accounting period 2. So ending inventory here moves over to the next accounting period as beginning inventory, and the cycle starts all over again. When we have merchandise inventory, we might have incidents that happen where goods get damaged in our warehouse, things get destroyed or wrecked or stolen, and so we have what we call inventory shrinkage. We need to adjust for this by debiting cost of goods sold and crediting our inventory account. So this sort of works the same way as our supplies account. We go back and we do a physical count of our inventory, determine what the value of that inventory is. Then we compare that to what our financial records tell us is supposed to be there. We record any difference to cost of goods sold. Additionally, other things that we need to consider at the end of the year, in order to fully recognize our revenues, if we have any expected sales discounts that we know our customers will probably take, we usually record those. We also might record the returns and allowances that we are anticipating based on prior history. This is true of both the revenue side and the cost side, our purchase side. At the end of the accounting cycle for a merchandiser, we close the accounts just like we do for a service entity. We'll have a few new accounts in our closing entries. Our revenue account is now called sales. We'll close the revenue account in entry number 1. In entry number 2, we'll close all debit balance accounts. So in this category, we'll be adding the sales discounts, sales returns and allowances, and cost of goods sold accounts. Closing entry number 3 closes the net income or net loss, and entry number 4 closes dividends. Let's go take a look at problem number 5 in your workbook. I will ask that you pause the video here and take a look at completing that on your own, and come back and review the video once you have taken a shot at doing this on your own. All right. So you attempted problem number 5. Let's see how you did. Problem number 5 starts with QS 4-9. We're taking a look at the inventory. A physical count of the year-end inventory tells us that we have available $35,900 of inventory. Our financial records tell us we should have $37,800. We have had some inventory shrink. We will record that by debiting cost of goods sold, and we'll debit that for the difference between the two numbers. So our accounting records say it should be $37,800. We actually have $35,900 on hand, so our difference is $1,900. We will credit the merchandise inventory account for that same amount. In QS 410, we're asked to do the closing entries. Now, what we have to remember when we're doing QS 410 is that our number for cost of goods sold does not include that $1,900 that we just entered above. So we'll need to remember to include that when we close cost of goods sold. The first entry that we do for our closing entries is to close the revenue accounts. To close revenue accounts, we will debit them. So we're going to debit the sales account for $160,200. We will credit income summary for the same amount. There's only one revenue account. Entry number 2 closes all debit balance accounts. Our debit balance accounts, other than dividends, that gets closed on its own, will be credited or will debit the income summary account for all of those and will credit the debit balance accounts. The first one that I see is sales discounts, and we're going to credit that for $4,700. Remember, that's a contra account to the sales account, so it has a debit balance. Same with sales returns and allowances. That will be a credit of $6,500. We'll credit the cost of goods sold. And here's where we need to remember that $1,900. So we added $1,900 to cost of goods sold. So it will be the $105,000 plus the entry from above. We will credit depreciation expense. I'm just going to get all of the expenses here now. We've got depreciation, salaries, and miscellaneous. And our credits are $10,300, $32,500, and $5,000. We'll come in and do a sum to get our debit amount to the income summary, and we'll sum up all of those numbers. And we get $165,900. Entry number 3 asks us to close the income summary account. And let's notice something here. Our income summary had a credit of $160,200 and a debit of $165,900. That is telling me that we had a net loss. We credited our sales were only $160,200, and the sum of all of our expenses and debit accounts was $165,900. So to close income summary this time, we need to credit income summary. So let's bring that down here and let's do our credit to income summary. And I know that I need to credit income summary, the difference between what my debit was, 165.9, minus what my credit to income summary was. So I had a net loss of $5,700 this accounting period. When I have a net loss, that affects my retained earnings, right? Net income increases retained earnings. A net loss will have the effect of decreasing retained earnings. We used up some of the earnings that we had previously. So we're going to debit that for $5,700. Finally, we'll close our dividends account, and that's a debit to retained earnings. For $7,000 and a credit to dividends for $7,000, closing out the dividends account. That concludes this lesson.